Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Jonathan Nurick, the founder and co-CIO of DivGro, an Australia-based investment management firm that puts dividends at the center of its investing strategy. Jonathan started DivGro at a relatively young age, and the firm's AUM has grown substantially over the recent years. In this intriguing conversation, we covered the founding inspiration behind DivGro, how Jonathan began to center on dividends as a signal, what people underappreciate about dividends, portfolio construction, including concentration and position sizing, and what a quintessential DivGro investment looks like. And without any further ado, here's my conversation with Jonathan Nurick of DivGro. Jonathan, you started DivGro at a relatively young age. I'm curious about what drove you to start your own investment firm.
Thanks, Ben. I was working in my family office and I was given what felt like a tedious task every day. My father, who himself was a successful hedge fund manager before our family office, would hand me a stack this thick of envelopes every day. And the envelopes contained dividend statements. Company by company by company, you'd open it. And the idea was, or the exercise was, your Costco dividend, let's call it $1 per share, market compared to this time last year. Is it 10% higher, 15% higher, 20% higher? Good, fantastic. Next envelope. At the end of the stack from one financial institution, you move to the other one. It felt almost like rudimentary work, but what you learn after 100, 1,000, 10,000 envelopes is that there's a feedback mechanism taking place here, that the financial industry has so much coverage about everything going on a minute-to-minute basis. But there's this secret clue or secret language that companies are communicating with you, the holder, and the feedback that you're getting via this dividends is like no other out there in the marketplace. It's cash, it's received, it's in your pocket. It can't be changed now. It can't be adjusted. And we thought that was a system, or our investment system grounded in dividend growth, was one that was proving effective from a compounding standpoint, but really had this behavioral edge. And I was approaching my 30th birthday, and I really looked at most of the people I admired, and they had built something. And I wanted to set about building something, and we had this wonderful IP and this wonderful mechanism. And it so happened that a few families around us who had reached that liquidity point in their businesses, they told us, we've gone to various funds, various advisors, various handholders, and the outcomes are good, bad, indifferent, but we really like the focus here on feedback, on experience, and the compounding is working great. And I put those two things together and I thought, here's the opportunity. Let's go.
And I'm curious, it sounds like it sounds like with the family office, you were investing in dividend paying stocks. Was that part of your dad's business as well, and focus, or like where did all of the interest in dividends originally stem from?
My dad had understood early in his career that there's a gap or a chasm between what the instrument delivers, an investment instrument, and what the average holder in that instrument produces. You've seen all the studies. You've seen the results. And he understood that trying to build in psychology, emotion, feedback into the investment process in a tactile, easy to follow way was critical for the success of the investor. And assuming the compounding was working, the investor would be able to stay the course get the outcome, keep their money in the fund, or even add money and add more people who were in their circle. And that became a great success on a win-win-win basis. And after the sale of his business and the beginning of our family office, started exploring other strategies that had this psychological focus. And he identified some research out of MIT back in the late 50s and early 60s, really spearheaded by Professor Myron Gordon. His team went on subsequently to win a Nobel Prize. And he was fascinated by this dividend growth methodology. So to summarize briefly, what they found was, one, that dividend-paying companies as a category outperform those that don't. There are outliers. But as a category, if you were to bet on all of the payers versus all of the non-payers, your dispersion would be tighter, etc. And then they found further that companies that increase their dividend perform better than those that simply pay a dividend, and that those that increase their dividend the fastest outperform the most. And they build this model called the dividend discount model, or the Gordon growth model. And essentially it stipulates that there is a relationship between the rate of change in dividend and the rate of change in price over time, and at points in time. Where the dividend goes, the share price follows. And if you have a long enough horizon and you're able to really lean into this, you could identify, if you could identify, a company that grows its dividend at a very attractive rate for a very long time, and you should have an expectation to make the same. Now, here is the feedback aspect. Once you begin investing in these, you're getting real-time feedback that is unlike, say, your typical earnings or free cash flow, which is important. Of course, that is how the dividend is paid. But for the passive investor, who's not maybe an analyst covering this 24 hours a day, they are getting something that can't be adjusted. There aren't different interpretations of what free cash flow means. There aren't pages of reconciliations at the back. There's just one number. And if you build a portfolio of companies like this, you can get almost daily feedback system that says the company is making the progress. The market will reward me over time. And once you have that light bulb moment of these companies on average are very good, there's only one way you can compound your dividend at 10 or 15 or 20% for a long time. Everything up the chain has to work. And that's one good proxy. And two, it will keep you even keeled, or is more likely to keep you even keeled. Everybody understands what dividend is, from the most sophisticated down to a novice. And the fascination comes from this idea of, it's not just the what to hold. There's an important aspect of the what to hold plus the how to be a holder of that instrument. That's where the fascination in dividends comes from.
You mentioned the Gordon growth model. I mean, 1950s from in the financial world is like a lifetime ago, right? Most of the people who were investing there are no longer investing. I mean, save for someone like a Warren Buffett. So I'm just curious, like modern day investors, you never hear about the Gordon growth model anymore. What do you think people might be missing about it by not, kind of thinking about it as part of their process and their analysis?
I think there's a lot that's being missed or underexploited. One is, Gordon and his team didn't stipulate the time frame. So when they prove the relationship over time, if a dividend growth rate can be sustained at a certain rate over time and at points in time, the share price will follow. That doesn't necessarily lend itself to immediate, I must be right today, or there's a big professional endeavor of needing to make the quarterly numbers or make an annual performance number. And while over time, the market price tends to be rocked, it's a pretty efficient price discovery mechanism, you can have periods where the dividend and the price can dislocate from each other for a while. And so the first aspect, I think, is that the time scale that people operate on is quite different if you don't necessarily have a definitive time frame. Now, in all of the research that people have done on these systems dating back to the 50s and that we do in-house today, On a rolling 5-year basis, the relationship is extremely, extremely tight. But 5 years is quite a long time. Now, most of the time, it doesn't take 5 years to manifest. It often is true most of the time or all the time. But people don't think in that kind of time scales. And the second one is that all of the research proved a relationship, but there was nothing that these professors in their research showed of how to identify these companies. Now, the past is a pretty good indicator. There, for example, are the Dividend Aristocrats, which is a title bestowed upon them by S&P of those companies that have grown their dividend for at least 25 years in a row without exception. And that's a pretty good hunting ground. The only problem is that 25 or 30 or 40 years in the past are past. We're only going to get rewarded for the future. And so what we set about is identifying those parameters, those things that indicate that a company can grow its dividend fast in the future rather than in the past. And nowhere does it say, how are you supposed to do that? We had to do that from scratch. It's easier for somebody, well, it might be more interesting to somebody who's thinking short term. Let me try find the thing that might go up the fastest and where there is lots of research or lots of evidence that tells me how I should go about finding it.
And as you mentioned, I know we try to figure out the companies that are likely to increase their dividend and capture those dividend increases without giving away the secret sauce. I'm interested in the process behind that.
It's an interesting and iterative process of gradually learning what pieces of data are most informative. I guess a very important starting point is most people, when they hear dividends, their first question is, what is the opening yield? How much am I getting today? They treat this as an income source.
Yeah.
And we say, we respect that some people simply need that income source and they need it now. But if one does have the benefit or privilege of a longer time horizon, it's entirely the wrong question. It's not about how much today. It's about how much this can become. In fact, we like to think of, in terms of income stream, the growing income is the safest income, and the faster it's growing, the safer it is. So we invert the question and we say, if you want your income stream to grow very fast, what would prevent it from growing very fast? And the starting point is that the payout ratio is really, really, really high. If a company takes almost everything that it earns and pays it out, little is being reinvested. And without reinvestment, it's not impossible, but it's harder for the company to expand or improve its dividend growing capacity. So in contrast to typical dividend investors, the payout ratios of our companies are really low. The lower, the better. And in terms of opening yield, we're looking for those companies that are overlooked for their dividend paying characteristics. In fact, these are relatively large companies. And we have even had the experience where we have seen the dividend growth or increase announcement. These are, S&P 100 companies. And we look at it and we don't think it's right. And we've written to the company and we say, in all of our models, we had a dividend growth expectation. It's very unusual to be outside of that. We can't make the numbers work. How did you get to this? And on one particular occasion, they came back to us a few days later. They said, we called an emergency board meeting. We just made a market announcement to retract our dividend increase statement and change it. We appreciate your work. How did you figure this out? And more importantly, how is it possible that since we announced that, we have spoken to upwards of 150 analysts, institutions, etc., no one's asked the question. No one has asked, how did you come to the number of the dividend? And the answer is probably because the company's yield at that point in time was well less than 1%. So the dividend's like a sideshow. And that's exactly what we want. We prefer companies that are family-owned, family-controlled. And the reason for the dividend is sometimes that you are in the third generation and you have 50 or 60 or 70 cousins that have enormous stakes in this business. It's too valuable to ever replace. They don't want the family to sell, but they have hundreds of millions of dollars per cousin, let's say, of value, but no income, and the family doesn't want to take egregious salaries, etc. And so they turn on this dividend, often to prevent the people from selling so the family can keep control. And now that's a small amount out of what they earn because the primary objective is to reinvest. And we look for companies that can reinvest in a very sheltered way. That, yes, it's nice when return on capital that you reinvest is very high. That's what most people are measuring. But equally important, in our opinion, is that the longevity and the framework around that return are very predictable and nothing can interfere with it. We own Home Depot as an example, and we've owned it since the inception of the fund. And just a few weeks ago on the earnings call, when they were talking about investing behind opening new stores, they said, in their view, committing capital into opening new stores is as safe as buying treasuries. That's a pretty strong statement. Now, the return expectations are obviously way higher than a treasury, but such is the predictability around the expectation of building such a store. So that's very important. So those are conventional data points, perhaps, but some of the unconventional ones that we look at to try and guide us how this company is likely to behave under stress. Companies sometimes fall under stress, either an own goal or sometimes because of something in the marketplace, a COVID as an example. We look at things like charitable giving, which we track for our companies, and it's surprisingly informative. We have assembled over time 120 parameters that we track. Some, like I say, are quantitative, others are very qualitative, and that helps us stay on the path of those companies that, one, will be able to compound their dividend fast in the future, and two, when push comes to shove and the environment is very difficult, they will, at least as long as they can, honor that bond with their shareholder.
It's all very fascinating. It's so different from, I think, a lot of the way that most people think about dividends. I want to get to the strategy specifically, but I feel obligated to ask the question about dividends as a form of capital allocation. We've had some guests who see dividends as a poor form of capital allocation and, prefer buybacks. So I'm just curious, as you think about not only that these companies pay dividends and they're increasing, but how you assess and think about, well, is there a better use for that capital, irrespective of what they could grow if they could grow the dividend? What if they could buy back 4 or 5% of their shares, and maybe that's more accretive? How do you, how do you assess and all and kind of think about all of that relative to the capital allocation mix?
So the people you refer to on your show, they're correct in an economic sense that if you can reinvest every dollar at a very high and predictable rate of return, that is the optimal mechanism for allocating your capital. However, the shareholders are still people. We're still emotional being. Everybody's somewhere along the continuum of, let's call it, investment emotional resilience. Maybe somebody like a Warren Buffett sits at the top and somebody else at the bottom, and everybody else is somewhere in between. And we need to be able to get through. The compounding journey of decades is made up of quarter by quarter and week by week and day by day of making a decision to either do something or not do. And if you're in something that's wonderful, ideally it's the not do. Now, coming back to this concept of feedback, it was interesting. The US Open just finished, and during the tournament, I read an interview about Yannick Sinner. And it turns out that he was a champion downhill speed skier and an emerging champion tennis player as a boy. And he decided that he preferred tennis. And the reason wasn't necessarily because he was better. Of course, you just watch the talent, right? But talent alone wasn't going to get him there. What he found was that on the tennis court, after every shot, you get feedback of how good your shot was. At the end of every point, you know how you're progressing relative to your opponent, every game, every set, every match. Whereas downhill speed skiing, and I know basically nothing about downhill speed skiing, other than that, he said, while you're doing it, it's just the closest to perfection. You don't know how you're doing relative to the clock, relative to the competition. And it's a very challenging process to operate and try excel in a feedbackless system. So I come back to your question, and your question was about optimal capital allocation. Buybacks are wonderful. The problem with buybacks is you don't necessarily receive, a professional maybe understands exactly what's going on because they're very close to the numbers. But to the average investor, you receive the dividend in cash. You can see it happen year after year. You can see it go up and to the right like a staircase while the share price traverses a roller coaster around the same curve over time. But there isn't a continuing feedback. What tends to happen is when companies over-earn and they're not sure what to do with the capital, sometimes they'll buy it back, or sometimes very good buyback. Companies, when the price is particularly cheap, they'll even borrow and buy back the stock, and that's a good use of capital allocation, but it's not necessarily recurring, and it's not necessarily tactile. So while it might be optimal, we think it's a good addition to this dividend pathway. Many of the companies that we own are fantastic repurchases of their stock. But to the investor trying to stay the course, the dividend is a much better feedback mechanism to build better habits. Every endeavor that's challenging requires a habit formation. So a person might be able to visualize trying to lose weight, get fit. And a lot of people don't necessarily have the inbuilt wherewithal to wake up at 5 a.m. every day in the rain, go for a run, then have a salad instead of a burger, whatever it is they're trying to achieve. And so a typical approach might be you hire a coach, a personal trainer, because when somebody's knocking on your door at 5 a.m., you don't really want to let them down. And they're helping you along that journey. Now, there's not that much that a company's board can do to help the passive shareholder, which are often numbered by the millions, along that journey. But the dividend is a crutch. The dividend, if that's what you're receiving and you count your announcement, what was it? Then the day you became entitled, your X date was a little cause for celebration. The day that you received it is good piece of feedback. And then when they announce the increase, ideally every fifth quarter, because they'll typically pay 4 quarters of the same dividend, it's like a day for celebration. The feedback is on track. You're on your goal. Your coach is telling you, oh, we're running faster, we're running further, we're losing the weight, whatever it is. The dividend serves a much better format of keeping you on track, while we concede that buybacks are more efficient from a tax perspective, and they can unlock extra value. And many of our companies do buyback.
There's a piece of the equation that I want to double click on because you've hinted at it, but I want to make sure that it's explicit. You seem to be correlating the ability to stay the track with higher returns over time. And I just want you to make that explicit and maybe weave in the dividend aspect, because there's the stock. You could continue to get a dividend and stay the course, but it may not be the right security to own. And it may, they may raise it a penny every 2 years or every year. And that's not really what you're looking for. So I'm trying to square some things and kind of solve this equation, which is, this A plus B equals C, which is higher returns. You've got one component as the dividend increase and another component is staying the course. How is that all intertwined in a kind of a tangible way?
It's a fantastic question, because if we come back to the foundational thesis here, where the dividend goes, the share price follows. A key parameter here is that the dividend grows at a very attractive rate. If the dividend grows, as you say, by 1%, 2%, 3% a year, and the expectation, therefore, is that the share price grows at 1 or 2 or 3%, that's a pretty lousy outcome. That's not what we're going for at all. So while we say that it's important to think about the psychological approach to the instrument that you're going to hold, nothing should overlook the fact that the instrument must be good. And so we set ourselves the internal objective of achieving average annual dividend growth in the mid-teens on the basis that if we can do that, and we've been very successful to date doing that, then the share price will respond at about the same rate. And we're very careful. I mentioned before the dividend aristocrats as an example. If we look at them, a lot of them are the great dividend growers of the past. You take a Kimberly-Clark or a Colgate, which for 20 or 30 or 40 years grew their dividend at high teens rates. Wonderful for both objectives. Fantastic instrument, company compounding tremendously, paying out a rising dividend at a fast rate, share price following, keeping the investor on track. But then, and we can go into the specifics of what took place in their businesses, if you like, but today they can't grow their dividend at more than low to mid-single digits. So as part of our 120 parameters, which we discussed briefly before, we are testing all the time. Can the dividend growth rate of our companies be maintained? Has it got potential to accelerate? And sometimes companies, even mature companies, can sometimes find new areas which can cause an acceleration. That's tremendous. And we're terrified of those that won't be able to sustain the rate. That's one of the most pressing considerations. Every day, we're going through our company's testing. What is our next 3, 5, 7-year horizon of the dividend staircase that we build? Now, how does that look? How fast is that? Build in some margin of safety for businesses dynamic, sometimes conditions difficult unexpectedly. Are they going to, at the very least, be able to clear the 10% a year dividend growth rate, which we consider a decent outcome? We're obviously aspiring to much better than that. And that means that the universe is relatively small. We're not saying that there are countless companies that meet these criteria. The universe that we operate in is a little bit under 100 companies that meet our criteria. And out of that, we build our portfolio. And in any given year, about 10% flow out and a handful come in because there's some wonderful companies that haven't yet been paying dividends and they move to the next evolution. And we've been admiring from the sidelines for a while, and now we can consider them formally. And some companies, as I mentioned, are no longer able to compound their dividend because at a fast rate, they have to be excluded. And that's why it's no surprise that a lot of the companies early on their dividend growth trajectory, unlike, say, dividend aristocrats, are able to grow their dividends at 15, 20, 30% a year for a period. It might be a decade before that tails off. And that's really what we're trying to hone in on.
I think you've given us a very good foundation, and we've covered a lot about your approach. So I'm curious about how everything we've discussed so far manifests itself in a living, breathing investment portfolio.
Okay, so we construct our portfolio with the finest dividend raisers that we can find. Now, that means that there are a lot of areas of the market that we won't go into or can't go into. Not because they're necessarily wrong or bad, but because the environment doesn't allow those companies to grow their dividend up and to the right without the choppiness of sometimes that going against you, share price follows, the feedback mechanism completely falls apart. So you won't find us in things like shipping, in airlines, in resource companies, where the price of the underlying resource, which is outside of the control of any given company, has a very significant bearing on what their earnings are going to be like, and therefore what their dividends are going to be like. So what we do end up in are businesses that are highly predictable, highly recurring, and very critical. They can't be switched off. It's critical software, critical business services, critical medical devices. We essentially want a product or service that, whether it's a consumer or a business, it is something they wouldn't even consider changing, turning off until, they close up shop. I'll give you an example. We own a company called Cintas, Cintas is an interesting story, and we've owned it since the inception of the fund. Cintas was founded during the Great Depression by circus performers where the circus closed down because people didn't have the discretionary income to be able to go to the circus. And they literally drifted around looking for some enterprise to do. And they noticed that outside like mechanical shops, the shop would discard old racks. And they said, can we take this? And yeah, of course, do what you like. And they took them, they cleaned them, and they brought them back or went to other shops. And they said, these are used, but they're perfectly clean. I cleaned them myself. Everybody is in a trying to save money mode. Would you consider buying this? A little bit like when you go to golf course, you can buy the brand new out of the box expensive ball for $10 or $15. And there's often a washed version because somebody hit that into the creek and somebody fetched it, cleaned it, and brought it back. And it's basically the same. And that business has evolved into the undisputed champion of critical uniform solutions, where daily, to make sure that a company's presentation is one, compliant, because lots of occupations, whether it's people cooking in a kitchen or working in a hospital or working in a semiconductor foundry, need to meet certain regulatory requirements. They deliver to 1.2 million businesses daily a compliant uniform where doing it yourself is a headache, but you absolutely need to do it. And it's easier to outsource to somebody else. Now it represents a tiny amount of their total cost of operating, but it's not something that can be overlooked. And so Cintas has that degree of predictability. In our view, they have an expanding royalty on the operation of American business, the uniform wearing American business. Their total addressable market is about 16 million businesses. So they can still roll out, 10 times what they are. And they've been doing this since the 30s. They've managed to find adjacencies where they're also what they call wrap-based businesses, where I'm coming to deliver you compliant uniforms, but who's making sure that your fire alarm and sprinklers are compliant and being checked? Can we do that too? Can we also do your first aid and safety compliance checks on long recurring contracts? Once somebody is providing a good service, there's no reason to go and look for somebody else, especially when you're working with the biggest. And so coming back to the dividend approach, Cintas has a low payout ratio because they primarily want to reinvest in more laundries, more facilities, more people driving these vans around. But they believe in sharing a small amount of what they earn, which goes up and to the right over time, with the family, the founding family that still controls this business. They have grown their dividend for 42 years in a row, unblemished record. The average annualized dividend growth rate is 19% a year. Now, it's true a lot of the market likes to look at those exciting, sexy businesses that meet the front page of the newspaper every day, and that's fine. But here is something that is overlooked. It is boring. And from a dividend standpoint, the market is not so interested in a company that is essentially a growth company that pays a dividend where the yield is very low. It's about 1% or a bit less than 1%. And just recently, a few weeks ago, we had our model going into the dividend increase announcement. We had 15 to 16%. This is a $90 billion company. The Bloomberg consensus, covered by everybody, the Bloomberg consensus for the dividend increase was 7.7%. It comes out at 15.4%, so right in our range and in the sweet spot of what we're looking for. But there's such a big gap between the dividend growth expectations of the street and those that are really focused on that, because that's just a sideshow for most of those looking, because most of those interested in dividends are looking at those high yielders, which we think are attractive. So Cintas is the kind of company that we're after because it's so critical, it's so boring, there's little changing, it's programmatic in terms of how it develops. It's just going to add 100,000 customers and then another 100,000 customers. in a progressive way. It's got quite a lot of operating leverage. We can forecast this out. And that's really what we're looking for.
With all that in mind, and maybe using Cintas as an example, I'm curious how you approach concentration and position sizing within the portfolio.
We approach it in two ways. The first one is we recognize that it's important to concentrate in your best ideas because you don't have that many good ideas. On the other hand, one, business is dynamic, and two, we're human. People can make mistakes. We try our best not to. And so what we do is we construct a portfolio that is internally diversified because we have all of our capital, as you would expect in our own strategy. And that leads us to about 30 companies that we own, and that creates a feedback mechanism of frequency of reporting. So every week, and this was a big innovation when we decided to open the fund, we spent a lot of time building our reporting system with leading psychologists, psychiatrists, and academics in the field, because we wanted to address the need for enhanced or enlightened feedback in an innovative, more powerful way. And we write every Friday at exactly the same time a 1-minute email to our clients. And lots of people that join the mailing list, they ultimately tend to become our clients. And it says the following: this week, for argument's sake, Cintas increased their dividend by 15.4%. And we became entitled to our dividend from Costco and received our dividend from MasterCard. They're all much higher than this time last year. Tick. 2 sentences about what makes one of those businesses special. End of story. No mention of price. If the dividend keeps compounding, this should work over time. And 30 companies is around the sweet spot of concentrating enough on our best ideas, having internal diversification between industries, and satisfying this need for a frequency of feedback such that we can take the long term and compress it down into the most manageable short intervals, because we see investing as a marathon, but put together out of thousands of short sprints, having to get through the week. And 30 allows us a dividend increase once per company per year, etc. Each time a dividend is announced, received, and we can communicate that well.
I think just about all the companies you've mentioned trade in the U.S. Are you just focused on the U.S.? Do you look outside of the U.S.? Tell me a little bit about the geographic exposure today.
Today, we own 30 companies, and 3 are outside of the US. Now, we'll only invest in, let's call it, stable democracies with stable currencies, or as stable as one can find. And we don't want to take geopolitical risk or excessive currency risk. But more importantly, in any given space, we want to be in the absolute apex predator, or in the case of duopoly, sometimes 2. So we'll own S&P and Moody's, or Visa and MasterCard. But the reason for that is, if you're taking infinite horizon, eventually, especially in smaller economies than the US, the leading player in a field that we like might have to grow and out of its market and into somewhere else. And we don't want to be faced with the problem of coming up against the giant that is in somewhere else, or just you started in your own geography. And those tend to be in the United States. We happen to own a few companies, say, or 2 companies in France, which are the leaders in their field. So L'Oreal in the case of cosmetics, and Hermes in the case of super luxury handbags, and a company in Canada in critical residential services. But that's because they're without peer in the United States. And the second reason for investing in the United States is that, unlike many countries where dividend behavior is sometimes an annual dividend or a semi-annual dividend, and it's often different, it's not the same number of cents or dollars per share per quarter. In the United States, you have this quarterly cadence of I pay, I increase. And it's easier from a habitual conditioning framework to transmit the information that way.
It's broadly true that larger, more established companies outside of the tech world maybe are more likely to pay dividends than are smaller companies. With that in mind, I'm curious what market cap ranges you focus on and if you would go into smaller companies as well.
In our fund, we have minimum liquidity, which we think is important for people, especially on the way in. They like to know that they are able to access their money. And so that lends us to generally large companies. Today, the median market cap would be in the order of 75 billion. And we have companies that are in the trillions, like a Microsoft. But we are not shy to go down the scale, but still liquid enough to that high single-digit billion market cap, provided the free float is enough. Because as I mentioned earlier, it is often the case that the most explosive dividend growth will take place when a company is a little bit smaller, earlier in their dividend trajectory. So I guess the two extremes in our portfolio, I mentioned Home Depot, we also own Lowe's. And Lowe's has been compounding its dividend, growing every year since 1961 at an average annual rate of about 15% a year. It's an incredible record. But we own companies that are in the early innings of their dividend growth trajectories. We own, for example, Wingstop in the chicken wing quick service restaurant space. It actually just opened in Sydney, their first Australian outlet, a couple of months ago. And out of interest, I mean, it's only one unit, though there's a commitment for many more with a local franchisee. But we sent people in our team every few days to go and monitor the queue, see who's in the queue. Then we went there and we ordered the entire menu. We called it research. It was fun. We tried every item that they make. But Wingstop is early in its development relative to, say, a McDonald's. And we have owned McDonald's, but the most explosive dividend cadence will often happen earlier as they move towards that ubiquity. So we're not shy if we can find something very attractive to go down that scale.
And one of the most important aspects of all of this for you is staying the course as the portfolio manager. And, we've already talked about the fact that if you want to benefit from all of this long-term dividend growth, you want to own a stock for many years. So with all that in mind, what is your target hold period for these investments?
When we opened the fund, I mentioned we started on my 30th birthday, and I told our initial investors, and we still maintain the same thing, that I'm taking an initial horizon of 30 years. Our core objective, and we hope to achieve it, is to take each of my dollars and everybody who comes with us and compound it from 1 to 30 over a 30-year career. May well go longer. A lot of the people I most admire, like a Warren Buffett or Charlie Munger, did it till their deep 90s. But it's a good initial target. Now, we're right on track. To be able to achieve 30x in 30 years, you need to compound at about 4% net. And we start every letter, which we write twice a year, in addition to our weekly installments, of the chart of how a dollar goes from 1 to 30 and where we are relative to that, to keep the frame in focus. Now, ideally, we can hold the same companies and they'll stay the course and they'll compound their dividend at least 1 to 30 over that time frame. But that's not always the case. Sometimes a company runs out of an ability to keep growing its dividend. And sometimes there are companies that we will probably own that haven't yet begun to pay their dividend. They might not even be public. And every so often, companies that are those that we very much admire enter our universe. So a couple of years ago, Alphabet, which we stood and watched and admired from afar for a long time, believing that they should already be paying a rising dividend, decided to start doing that. They come into the universe. Companies that we have admired from afar and actually don't own, like Bookings, we like, they're in our universe. We don't own, there's every possibility that the nature of the companies in the portfolio will change. But our turnover is low. Our turnover is about 10% a year. It implies that we let go of 3 and add 3 on average, sometimes a bit more, often a little bit less. And from a feedback standpoint, we actually have a very interesting personal story about how dividends are so empowering in this. We own a medical device company called Stryker, just as an example. And their emerging growing business is the Mako robotic surgery platform. Stryker pays dividends. It's a family-owned and controlled company. And they've been able to compound the dividend in the order of 15% a year now for decades. They have a peer in robotic surgery called Intuitive Surgical, which we study and which we admire, but which does not pay dividends. We actually know somebody in the founding team, a surgeon who was very close to it, essentially owned stock from day one, had best information you can imagine, and made tons of their capital through the appreciation of the stock. Now, in the absence of dividends, because the share price would trend up and to the right, but sometimes, as stock prices do, can sometimes fall fairly precipitously, was unable to stay the course. The price has gone up way over 100 times since he let go. He just couldn't manage the feedback of the share price going up and down, even though it was scaling many hundred bagger course along their way. Now, he made quite a lot, but most of the gains were still to come. Now, we don't have the exact parallel because he wasn't a Stryker shareholder at the same time. But our contention is that receiving that rising dividend as a form of feedback lifts you significantly to being able to stay the course. A little bit like if you want to get fit, get healthy, lose weight, you still need to do the work yourself. The coach or the personal trainer will help you along that journey, but you still need to be the one who chooses the broccoli rather than the burger and goes for a run instead of watching the TV. But the help is like a crutch, and we're very strong believers in that.
And I can imagine any number of reasons that you would sell a security, someone cutting a dividend, someone, not raising their dividend. You some kind of belief that the dividend growth from here on out is not likely to be attractive. I'm just curious, in that on 3 on average that leave the portfolio every day, what are the common characteristics?
So fortunately, we've been successful at avoiding any dividend cuts. So we have an unbroken record, which we hope to maintain, of dividends that are only increasing. A common characteristic is that the composition of sales growth is not what we consider optimal. What we want are companies that are doing something for their customers as opposed to, say, to their customers, and are offering a very compelling value equation to the customer, so that it's not trying to extract the most that can possibly be paid for this thing, but that the value equation is really compelling. Now, in previous decades, the fast-moving consumer goods companies or personal care companies were very attractive, whether it was baby diapers or toothpaste, etc. Now, the program used to look like this. They were the leading American company, and they used to take their profit pool and go into other geographies and advertise during the soccer or the cricket or whatever was the relevant place, and send their salespeople or reps to all the dentists or GPs or whatever it is, and tell them about the merits of the product, and they gradually win their share. And the composition of sales growth looked like this: 8 or 9% more units being sold, more people want this product, and 1 or 2 or 3% price mix. So increasing the price or cleverly changing the number of units inside the package, but really changing them. And as they matured and started, let's call it conquering the dominant market share position in many of these geographies, we look at the sales growth composition, and it goes from 9 and 1 or 9 and 2 to 8 and 3 and 7 and 4, and on you go until all that's left is increasing the price. they do it cleverly. They add a mint strip, a green strip, a charcoal chip, a whitening strip, etc. So there's there's somewhat of a creation of more value, but they're not finding more people to sell this stuff to. And if you can't do that and you're only left with price, if you keep exploiting that, you won't have any latent pricing power potential, which is a significant form of value in the future. And two, if people fall on hard times and there's a competitor or a house brand that doesn't do that and the price gap gets too big, person will shift. And that will be catastrophic or proves catastrophic. And so in all of those cases, we gradually let go of what were once dividend giants of the past because we don't believe that with the wrong composition of sales growth, you'll be able to power consistent sales growth, consistent high earnings growth, and therefore consistent high dividend growth. The other reason for sometimes exiting is significant change in board and management or leveraging and taking on tons of debt for a better company acquisition that we don't know much about or we think is not justified or a poor allocation of capital. And then we'll move on.
We haven't talked about valuation yet. And my guess is as people are listening to this, the, traditional valuation multiples and DCFs and things like that are going to be running through their heads. So I'm curious about your approach to valuing companies where you think the dividend will grow at these well above average rates.
So we start with our fundamental work, and it essentially culminates in building out what we consider the dividend staircase. If you take any of the companies spoken about, and you can chart it yourself or use your Bloomberg or anything else, and you will see it goes like this, like a ladder or a staircase. 4 payments increase, 4 payments increase.
Yeah.
And that's the past. And what we do is we try our very best to draw or picture what that will look like in the future. And if it meets our criteria of very impressive dividend growth, factoring in different risks, margin of safety, etc., we will take the view that over time, coming back to the Gordon growth model, the dividend discount model, the share price should correlate or correspond to that change in the dividend. Now we will take that implied share price in the future, discount it back to today, ask what is the market expecting us to pay, and assess whether we have catch-up potential, meaning that the price today is trading at a discount relative to the dividend growth implied price, if that makes sense. And of course, sometimes because the price and the dividend correspond over time, but not at all points in time, you can have a point where the price is too expensive relative to the dividend growth implied price appreciation, or too cheap. And we try and enter or increase our positions when it's too cheap in our assessment.
And when I look through the portfolio, I see a lot of mid and large cap, for lack of a better word or phrase, growth stocks. There's definitely a growthy element to your portfolio. So, someone who doesn't know anything about you just looks at the portfolio and says, Jonathan, he's a growth investor, right? I mean, and maybe he's a dividend growth investor. Maybe that's an accurate statement, but I'm just curious, how you think this differs from, a more traditional growth strategy.
So people like to put labels on things, and sometimes we're forced to participate in a label because an allocator has buckets and they're kind of forced to make the decision. We consider that their decision. We're trying to blaze a trail and build out the category of dividend growth. Now, we believe it has 2 forms. One, it's underexploited and clearly very effective. It works beautifully for us, and the research goes all the way back to the 50s, and you can trial this out any different way, and it works if you can execute. And then it has this extra, let's call it bonus, but we think it's critical, emotional bolstering aspect. Now, you're absolutely right that our companies are high quality growth companies. That's why it's not uncommon that somebody comes to us having heard dividends oh, the yield on your companies is less than 1% on average. Well, yes, that is true. However, if the safest income is the fastest growing income, we look back at some of our holdings that we have held in the fund or predating that in the family office. And while they never had a yield of more than 1% to the new purchaser, today the yield on cost is 50, 60, 70, 80 times what that was. Share price obviously went in tandem. So what we're trying to do is find those exceptionally high-class companies that do primarily reinvest. They're absolutely growth companies, but the dividend is serving one as a guidepost for them to allocate their capital astutely, in our opinion, where you allocate a small part of what you earn out by way of a dividend and you build a bond, an expectation in the shareholder base that that's going to grow up and to the right at a fast rate. You are a very judicious allocator of the rest of the capital to make sure that that can happen. Because if you have a record of 10 or 20 or 30, or in the case of low, 65 years of dividend increases, and you're unable to maintain that because of poor capital allocation decision, you will start again from zero. You will start again from zero. So we think it actually makes companies more astute or more discriminating in how they go about allocating their capital. It helps us, it helps their investors. It's a happenstance that people might classify these as growth companies. We think they're just outstanding companies.
Never like to leave a conversation with a manager without discussing a mistake. Is there a mistake that you've made that has forever changed the way you invest?
Interesting question. When we went out and started the fund, like I said, I opened the fund on my 30th birthday. It was so obvious to me, having done all the research, executed inside a family office context, that this deserved a significant allocation in our prospective investors' portfolio. It was likely to be the first and only thing that met these two key criteria. It was a very sound compounding investment with good credentials, good evidence, both empirical and academic, and it was going to provide, as long as we executed well, this reinforcement that our investors today tell us actually improve their whole investment portfolio because of this lens of emotional bolstering and what feedback to follow. But I took the bold step of that expectation, even though these people didn't necessarily know me or much about this. And you'd go to a meeting with your first few prospective investors, and 45 minutes in, they say, "This is fantastic. It makes so much sense. Why is nobody doing it? I love the sound of it. I'm very excited to go ahead. Send me the forms. What's your minimum investment?" And I said, $1 million. And they'd say, "How does 100,000 sound?" And initially I left quite disappointed with those meetings. But reflecting upon that, what I learned was you have to earn the right to participate in somebody's portfolio, however much sense it may make. And more importantly, you must never discount what that relationship can compound into. The checks that those people will write 2, 3, 4, 5 years later, the people they'll introduce you to, you must never discount that. And so the mistake was one of maybe expecting too much and having to learn to meet your investors where they are, build that trust, build that credibility, and how much that compounds in terms of the value delivered later. A little bit like how we enter companies that might have low yields to the new observer and what they can blossom into over time.
Well, John, I will say that you run one of the most unique public equity strategies, backed obviously by research and a fair amount of contrarian
contrarian perspectives. And so I think people are going to be really interested in what you're building and, this approach that you've taken. We'll close with the question we ask all of our investment manager guests. What is the most underappreciated aspect of the investment opportunity in front of DivGro today?
I think that we're students of psychology, and you might be familiar with the Adlerian psychology school of thought. He was a contemporary of Freud, and he used to write and believed that what we focus on is ours to choose. The reality is objective, but what we focus on is entirely up to us. We can fixate effectively and we can fixate less effectively or counterproductively. And the evidence is there. There is a giant chasm between what instruments do. Passive holdings, you can just go and buy the S&P and hold it forever, as Warren Buffett advocates, is good for most people. And that's fine, but the evidence is such that the average holding periods are really short and people's return is completely different to what the underlying instrument does. That's true in ETFs and stocks and funds and anything that's tradable. And the time scale is actually getting shorter, not longer. In the 60s, the average holding period of a New York Stock Exchange stock was a decade, and now it's in days and getting shorter. So for us, we think the most underappreciated aspect is this Adlerian effective fixation. If you tilt your lens a little bit and think about how I interact with my instrument, not just what the instrument's merits are, and you consider these two key considerations going in, as we do, you're much more likely to compound effectively over time. You only need to make a few significant mistakes in your compound and completely destroy the curve over an entire career. And that's what we're trying very much to avoid. So for DivGro, what we think is building out this category of emotionally enhanced dividend growth investing and everything that comes with it is what's underappreciated. And every day we're working to make it more appreciated.
Well, Jonathan, I don't know how many other people in the world are focused on that, but it's wonderful that you are. And I appreciate there's the there's the business of running an investment firm, and then there's also the aspect of making sure the outcomes are as positive as possible for the end investor. And I feel like you guys embody, a focus on the latter versus, just necessarily just scaling an investment firm. So we'll be excited to watch your progress. And I really appreciate you being on Compounders.
Thank you very much. Great to be here.